how does a financial advisor get paid? It's a legit question and one that you deserve to get an answer to.
Welcome back, everybody, to the CD Financial Podcast, CD Financial, where health meets wealth. I'm Marcus C., your host. That man, Chuck D., he is the man. He is a financial advisor. Am I correct in assuming that, sir?
Yes, you are. Yes, sir. You're correct, sir.
And I'm also assuming that you don't do this as a charity, right? You actually make money off of this. This is something
You know, I'm in a capitalist society, in a capitalist nation, right? And you know, I'm never greedy. But I will do what's best for you and what's best for our firm. Because if I don't act in your best interest and ours, then all the planning I do for you in a decade, if we're not financially sound and strong, then you won't be. Let me tell you this too, Marcus. I tell folks all the time that when I see them, they say, oh, I go, where's this money going? And they say, well, it's going to our kids. I go, but according to our plan, that extra $1,000 a month, or $1,500 a month, $2,000 a month, I don't think that's sustainable. And then there's a pause, and it's usually let's just say, usually one partner in the family arrangement has a harder time of giving up that payment until I say, look, if you're not fiscally sound, you won't be around for your kids in 10, 15, 20 years, and you can't provide the help. You can't have a home that you've paid for and that they could inherit and or, you know, come and move into or seek refuge at if they run into hard times. If you continue giving them that money in retirement, you're going to run out of money fast. And so you've got to remain financially strong and sound. And so you've got to have that conversation with your kids. And you have to say, you know, right now, I'm going to have to shut the bottle off because my financial advisor, and you could just blame us, said with the plan we've created, it's not sustainable. In other words, we can no longer afford to have this money going out. And if we're not around in 10 years, how are we going to help you kids? Ta-da! Exactly. I mean, that's it.
Well, good. I'm glad you're making money. It is a business after all. We are taking care of other people's money. So when I looked this up, and I found basically there's 4 payment structures or payment types, if you will, or ways that financial advisors make money. I'm going to go through those 4 real quick with you, and I want to hear your commentary on what's involved with each. Is that fair?
Sure. That does sound fair. And just a side note, folks, when Marcus says, we're taking care of your money, Marcus is not part of the firm, nor is he licensed. So he can't actually say we're taking care of, but he says what he really meant to say was when CD Financial and the firm is creating plans for you, then we're taking care of you. Obviously, we have to get compensated as well because we're going to be here for the long run for everybody that's out there.
Absolutely. We want everybody to win. Okay, so let's go through those. We'll start with fee-only advisors.
Okay, so there are some advisors that they may only charge a fee to plan. I haven't met any yet, actually. Mm-hmm. I've met advisory firms that charge an hourly fee or even a set amount. And it could range anywhere from, who knows? I don't even want to take a stab at it. $150 an hour to planning fees of upwards of $50,000 because they're very complex, higher net worth cases. And they may, so that's a fee only, where they may charge a set planning fee and or an hourly fee.
Okay. So then the second one, and to me, the first time I read this sounded very, very similar, fee-based advice.
It is. This is probably AI junk that's pushing out. So fee-based, yes. So this is where it could. Now, by the way, the reason I haven't met just fee only like hourly rate or a set fee for planning is because they also move into the fee-based, which means they're charging a fee for assets under management. And so in that case, no, there's some that might be fee only where they say, well, we don't care. Anywhere up to $1 million, we're only going to charge X amount, right?
Mm-hmm. Yeah.
But most firms charge a percentage of the assets that they invest for you, and they call it assets under management, or AUM.
AUM.
Which we reside in that realm in the AUM. Now, fees can range anywhere. They can range anywhere. But let's say there's a let's say there's a 1% fee. Okay, that's
Mm-hmm.
pretty standard. You see that around a lot. You see it rise above that. You see it go below that a little bit too. But let's say it's 1%. So you get $1 million in AUM, assets under management, and so you can do the math there. And that 1% could get charged monthly or
Mm-hmm.
quarterly. We actually utilize both depending on which models you're in. But quarterly, we call it in arrears. So we work for one quarter. Let's say it's January, February, March. And then in April, you might get an invoice and they say, oh, by the way, we've been working for you for the last 3 months. And that's the arrangement we have. So if it was 1% annually, it's divided by 4. So it's 0.25%, right? So,
Right.
yeah. So that would be like $250 on 100,000 or
Right.
2,500 on $1 million. And it works like that. Okay.
Okay.
Some advisory firms have like breakpoints. If you hit, $1 million, now you're going to drop your fee. If you hit 1.5 or 2 million, some have graduated. You're going to pay this much and it's not going to be retroactively discounted. So that's how that works too. Yeah. So
Okay.
that's a fee only and a fee-based services.
Yeah.
Now, this fee only, that is with fiduciaries.
Right.
So they're held to a different standard, of course. Theirs is a fiduciary standard when they're able to charge a fee, which means they're supposed to act in the interest of the folks that they serve or the
Right.
families that they take care of. Okay, what's the next one?
Next one is commission-based advisors.
Okay, so commission-based advisor, they get paid a commission when they sell something to you. So they're off of the fiduciary model into the commission-based model. So it's like suitability now. I have a story to tell you, which will help clear things up.
Please.
Yeah. But think of a broker dealer. I have two stories actually. When they might sell something through a broker dealer, that means that think of a real estate broker. When they sell a piece of property, whether it be a home or a commercial building or a piece of land, there's usually a 5 to 6% commission on that. So that's a broker that's selling you something. So that'll help you with a broker dealer. Think of a car dealer.
Yeah.
When they sell a car to you, there might be an amount that they get paid, right? And Marcus, what did you say? How do dealers get paid a lot these days?
So most dealers nowadays, they don't get paid on the markup, which I think a lot of people still believe. For the most part, they get compensated by units moved. So they're not making money on individual cars as much as they are in units moved or cars that are sold.
Yeah, the manufacturer bonuses them depending on how many they go. And also there's what's called dealer holdback under their cost, which is it's insulting to go there. In fact, I used to work on the Eastern Seaboard with a company, and it was my company actually, and we customized automobiles for car dealers. And I remember one car manager said, "You're going to send your friends in? Send them in now. We got 2 more days in the month, and there's a special incentive from the manufacturer on Honda Civics, and that's what they wanted to buy." He goes, "We'll give them $200 in a holdback." I go, "Don't you? I don't believe in that." I go, "Don't. I don't want that." I go, "Just give it to them at cost." And back then they were doing they rarely moved units at cost. The internet wasn't that huge, and then information wasn't shared, and I always felt like that was wrong, right? Yeah. And it was only a couple $100. And by the way, to give you more information on this story, they were shopping locally in Newark, Delaware, and the Honda dealer there was charging them like $1,200 to $1,600 over the cost. Yeah. And so we did them a one solid, and they got a great finance rate, and their experience was wonderful. They loved it. So they went to a Philly suburb to get that done, and it was great. So so broker dealer. So it's like, there's obviously a commission there, or there's some kind of a spread there with the car dealer, right? There's some kind of money that they make. And so when they sell a security to you at a broker dealer, there's probably a bid and an ask price. So there's
Yep.
always a spread there. And then the stock broker will make something, the stock jock that's, selling you something. But there's also, by the way, there's also a commission sometimes that we can't avoid right here. If you can see that, which that's usually out of view, because usually this tax plan, I talk a lot about income planning and then investment planning to serve your income needs and then getting rid of taxes. But healthcare planning. I mean, a lot of times we want to make sure that if something happened to you, like long-term care, for instance, it could ruin your financial plan.
Yeah.
And then you'd be like, what happened, Charles? Why didn't you solve for them? Or you as a client could say, why didn't you solve for my husband who's now got long-term care issues? Well, we do that. And I've never actually used traditional long-term care because the cost always goes up.
Yep.
And I don't like that. So it's hard to budget for something always increasing. So we use other solutions for long-term care. And whether we use traditional long-term care or alternative solutions, they're going to compensate us with a commission from the providing insurance company, the insurer. And that's the way it is. So I tell you as the family client, I say, look, we get compensated by the company directly, but I don't want you to pay any recurring fee. Now, when it comes to certain solutions, there is a monthly premium, and that's the way it goes, right? But if it comes to things that we're using to replace, let's say we're replacing bond funds, because when interest rates fluctuate, we can't trust bonds, or at least we don't trust bond funds. If you buy a direct issue bond, you have to hold it for 5, 10, 15, 20 years. So again, we're not typically doing that either. So we, at our firm, we get away from that. And so the company, to bring us stability, to provide income monthly to the client, and or also to make sure that your principal doesn't suffer any losses based on the claims paying ability of the underlying insurer. Mm-hmm. But they may compensate us directly. So that's a commission, right? And I tell you as the family, yeah, we do get compensated directly by the issuing company, but I'm going to make sure as much as I can that there's no recurring fee there for my client families. So I'm very proud of that. But at the same time, there's another story I can share with you, Marcus.
Yeah. Please.
Oh, there was a preferred stock issue for a real estate investment trust. And some of my families only held this for 2 years. Well, 95% of what they did was at a broker dealer, and they paid the reps like a 6% commission at the time. Now, this can vary, and this was at the time. This is an illustration only, but they paid a 6% commission. Well, the issuing company didn't know how to compensate the registered investment advisory firms that were fee-based as an IAR, an investment advisor rep. And so they would just give the 6% to the client. So some of our higher net worth clients, for easy math, they bought 100,000 of this, and that's typically what my clients bought, about 100,000 typically, and they went 106,000 overnight because there was nothing else to do with the commission. It was the way that it was structured, that specific preferred stock product. So some of my clients held it as long as 3.5 years. Some held it as little as 2 years or even 1.5 years, and they all got the same 6% bonus. Now, let's say we charged a 1% fee, and the yield dividend on this was, say, 6%. Then their net every year was 5%. They weren't looking for a home run. They were just looking to get something relatively stable. Well, they netted 5% for 2 years, 3 years, and they all got a 6% bonus.
Nice.
They were tickled pink on that. And I was too, because I was like, look, this is one of those cases where you're going to get that commission fed back to your position because we're not taking the commission. So I was pretty proud of that. But I was just trying to get something else for our higher net worth clients other than, our stable stuff and securities or stocks and index funds in the market. And it worked out really good.
Excellent. Okay. So how about performance-based advisors?
Well, no, that's not something that the typical listener is going to be involved in. But that is like hedge fund managers. They charge like 2 and 20 is common. They might charge a recurring AUM fee of 2%, so well above the 1%. And then if they go over a certain hurdle of performance, they might take 20% of the performance above that. So let's say they have to do at least 10%. Anything above that, and let's say they do 20% that year, well, they're going to charge you 2%, plus you're going to take 1/5 or 20% of anything over the 10% performance. So they might take another 2% or 1/5 of the 10% above their hurdle of 10%, right? So I know it's a lot of math, but it's a 2 and 20. But this is for higher net worth folks that are involving themselves with hedge fund managers and things like that typically. Okay. So I want you to know that.
Okay. Fantastic. Okay. So now, having covered all those fee structures, as it were, how people make money doing this, I have a question. So why don't I just do this myself?
Well, you could do it yourself, but if you get something that's just you doing it, what are you doing to remove this right here? How are you going to create a tax plan? How are you going to make sure that your investments are feeding your income and that it's going to do that for a lifetime? Oh, if you want to know why you should use a financial advisor, click here because we have another podcast that answers that. Why use a financial advisor? But it's kind of like getting a suit off the rack. It might be a little funky. It doesn't quite flatter you, around the midsection, right?
Yeah.
And, or it's a little tight under the armpits, or, it's a little baggy. And when you close it up, it's like, you don't look so hot. But if you go to a tailor and have it done for you, or a seamstress, it's like, wow, okay, that really fits you nice. That looks like a tailored suit. Well, that's what it's like when you get somebody that plans for unexpected occurrences or removes. What have you done to remove taxes from your retirement savings accounts, right? Are you sure that your investments are going to last as long as you do? That's what you're going to get from that. Oh, and by the way, folks, those commission-based, I didn't cover one thing. Maybe you have a bunch of mutual funds and they might not be tax efficient even. And you wondered why you were always in a mutual fund. Why weren't you in ETFs? Could be that there's a recurring internal payment or commission that's going to the advisor that put you there. So he was doing what was suitable, but he certainly wasn't doing advanced planning like I'm talking about. And so I don't like that story, but that story goes on over and over again. And there was early on in my career, the broker dealer that I was attached to would not let us use specific products that I knew or I felt. Let me just say, I strongly felt that they would serve my families in a much better manner, but they weren't on their approved list of products. And I was like, what is this approved list? And how do we get it on there? And how do we get this product that I want to use on there? And you know what I was told?
What's that?
Hey, Charles, stop asking so many questions.
That's never.
And I was like, whoa. When I get told that, I'm like, oh, so I should stop learning, right? That doesn't sound right. That just, the litmus test there, it was smacked of bad. Like somebody else is acting out of the interest of themselves and not my clients. And I was like, I'm out of here. I'm going to become an investment advisor rep. I want to get my Series 65 and I want to be able to charge a fee for service and act as a fiduciary in my family's best interest. Because I don't want anybody handcuffing me to a specific product that they want us to promote to our families. And that's what it felt like. We had this approved list of products, and I was like, what is this? Right? And there's all kinds of other things available here. And they were like, stop asking questions. I'm like, bye-bye. Now it took me some time and an event, I would say, to really push me out. And I'm so glad I did. It pushed me out the door, and it was a blessing in disguise. So that's why I say sometimes, when things happen, like you get encouraged to leave your employer, like that's been happening right now with feds, right? Yep. Or you get laid off. it may not always be a bad thing. Or there's your health changes. I have a client who's a forensic accountant, and he had a stroke. And
wow.
that was 2 years ago. And the last 2 years, he looks fantastic. And he shed all that extra weight and he's kept it off. And he says, I know I have to do this to keep living. And I'm like, you've never looked so good. I'm like, wow. I mean, he really does. And I'm like, this might really extend not just his lifespan, but his quality of life.
Quality of life, yeah.
Yeah, and he seems more energetic too. He does. I really like him too. He seems happier. He seems happier. He's not hauling around as much, right? Yeah.
No. Yeah, and that's physical weight is a mental weight too. So yes, you are.
And it wears on your joints and stuff too. And listen, I love y'all. I'm not knocking that, right? There's reasons why, but keep listening to the health tips at the end of these podcasts because I think they're invaluable. I love them. CD Financial, where health meets wealth. You got so it's fee based, which is a fiduciary. They act in your best interest. It's commission based, right? Yeah. And sometimes we have to cross over into that zone, but I'm only doing that for your benefit. And that's where we're at there. Okay. And I'm protecting you, and I really am. And then there's what is that other thing called?
Performance-based and fee-only.
Yeah, you're not going to see that too often. Yeah, you're going to have to get way up there in net worth. And then you'll see performance-based sometimes. Sometimes you'll see it. Yeah, and that about wraps it up. You got a health tip for us, Marcus?
Great information, by the way. I sure do. So I think it's safe to assume you're breathing right now.
I love it.
Are you breathing right now? I hope so.
Yeah, I'm breathing right now. I love it. Go, bring it to me. Come on, tell us.
Okay, so real quick, every now and again we get stressed out, maybe a lot now and then, not every now and then. So to center yourself, this is a great breathing exercise, is 4-4-4. And that is 4 seconds inhale through the nose, 4 seconds hold, 4 seconds out through the mouth. And you do that 3, 4, 5 times, and you will notice a difference in how you feel immediately. And it's great for when you get stressed. Stress can be a killer. Stress is not always bad, but generally it's worse for you than it is beneficial. So when you find yourself high-strung and stressed and you need just kind of a moment, 4-4-4. 4 seconds in through the nose, hold for 4 seconds, exhale for 4 seconds. You'd be amazed at how calm you feel after you do that. I
feel better already. I'm glad you made me do this. I'm getting wound up.
I do that all the time. It works great. It really does. It really does.
I find I'm exhaling longer than 4 seconds, though.
You can do that too.
I'm going to do a 4-6-5.
There are those who do 4-7-8. 4 in, 7 hold, 8 out.
Ooh.
Try it. Yeah, play with it.
Right.
But I think you'll find
that. I'm road trip here in a moment to my healthcare profession. I'm going to do that. I believe in breathing, and I've talked about fresh air, like when I drive up to Cambria and Central California coast. Oh man, the air smells like air. It's gorgeous. It smells so good. It's like, whoa, that smells like air. Yeah. I mean, it just smells so oxygenated. Your body's like, yeah, I like this. Give me more.
Cambria's great. Well, I think that's it, man. Thank you very much, as always, Chuck. We appreciate the good information. That's very helpful to us. These benefit everybody if you just take some time to listen to it. And, again, we just hope that this is helpful for everybody. So thank you all for joining us on CD Financial Podcast, CD Financial, where health meets wealth. I'm Marcus C., your host. That man, as always, is Chuck D. Chuck, thanks for your time, brother.